In today's video, we're going to be talking about VA loans and why they are the best way to get a home loan. And I promise this video will teach you something you didn't know about VA loans, so please stay tuned. Hi, this is Rick Elmendorf, and on this channel I give my opinions, advice, and real talk about mortgage and real estate. So if you're new here, please consider subscribing. So as a loan officer, I am always asked from veterans active duty, what's the best way to finance? Should I go conventional? And my answer is always no. Use your VA benefits. It is the absolute best way to finance a home. So in this video, I wanted to kind of break down some of the reasons and then give you my insight on a lot of the cool things that you can do with your VA loan. Okay, the first thing to discuss is the obvious. There's no money down and there's lower payments. Let me just get into a little bit more of that. Even if your entitlement or your eligibility is tied up in another home, you can still use your VA benefits again. Now, I call this rinse and repeat. And this is a significant advantage because many veterans or buyers don't have the down payment, or maybe it's just not wise to take their savings or pull money out of a 401k or retirement to make the down payment. The other thing that lowers their payments, not only the rates, and we're going to get to the rates in a second, but the fact that it doesn't have any mortgage insurance. Now, VA loans require for a funding fee if you're active duty or if you do not have a disability rating with the VA. And by the way, if you're getting any money from the VA, you have a disability rating and you will not have to pay the funding fee. That is a widely misunderstood concept for some reason. So there's no mortgage insurance, lower rates, no down payment, and that all equals a better loan for you. Believe it or not, you can have multiple VA loans at the same time. Not only can you do it over and over and over again, you can have up to 3 VA loans present at one time. This is a unique way people have built wealth with their VA benefits. So this is what's called the VA maximum loan amount calculation. I'm going to get into some cooler things like assumability if you have questions about that, but this is the VA maximum loan amount calculator. When you've used your VA loan, you have partial eligibility tied up. So let's just do a scenario here. How do I calculate how much entitlement I've used? Well, it's really easy. If you have your certificate of eligibility, it's going to say entitlement charge. You can just put that number in this box. The other way you can do is you can calculate what was the original VA loan that you got, and then you multiply that by 25%. That's going to tell you your used entitlement. So let's just say I got a loan, a VA loan for $300,000 times 0.25. I have used $75,000 of my entitlement. Now, the calculation is already kind of gone to town here and said, hey, your new base loan amount is actually $550,000. Wait, so you're saying, Rick, that I just bought a house for $300,000. I did put no money down. I'm now moving to a new duty station, getting another VA loan, and I can still do 100% financing. Yeah, that's exactly how it works. Your max entitlement is based off the new county loan limit. So I here in this case, it's $1,089,300. You multiply that by 25%. So that number is, as stated, $272,325. Now I'm also looking at the value of the new home, and that is $550 times 0.25%. That's $137,500. The way the VA looks at it is they say, okay, here's your new sales price, $550,000. We're going to guarantee 25% of that to the lender. The lender calculates how much you can borrow. They take the new sales price, they multiply it by 0.75, and then they add to that your remaining entitlement. Pretty simple, right? All right, well, I have my max entitlement minus what's been charged. So I have 197 left over. In fact, I could even go up to, let's say, 750 and bingo. Look at that. I'm literally like right on the button here. But anyway, this kind of gives you an idea of what you can and can't do with your VA loan. The principle is this: you can use your VA benefits more than one time, and you can actually use them to go 100% financing. You want to leave a little bit of entitlement remaining, meaning at least $1. But if you're going to be using it multiple times, like 3 times, you have to have entitlement remaining to use another VA loan. So if I have like 0 entitlement remaining, I can't use it again. Now, the good news is the loan limits continue to increase every year, therefore opening up more entitlement. There's really not going to be a case where you're going to have to play that game I just told you, but nevertheless, that's the rule. The other thing I want to talk about is the favorable interest rates. Now, if you have not seen this before, I'm going to go to my website where you can actually look at current rates. This is a conventional loan, 5% down. You're looking at a rate right around 5.875. Now, if I were to switch this to a VA loan, I'm going to go 0 money down. I'm going to go into advanced options and I'm going to select military. I'm going to check my rates. Look at the difference, 4.99. I mean, it's just not even close. Almost a full % lower in rate. Now, these rates don't even include the military discount that our company does. The other caveat to VA loans and why they are the best way to get a home loan is the flexible underwriting standards. In addition to the financial benefits, the lower rates, no money down, being able to use it over and over again, the VA loans offer a lot of more flexible underwriting options. There's a lot of rules that don't really exist in the VA world. Most importantly is the time to occupy the property. The VA knows that you are, let's say if you're deployed unemployed, or you're coming back, but you're buying a house, you're moving your family. Well, the VA doesn't have this strict 30-day rule. Actually, it's 60 days, excuse me. The VA says, well, yeah, you're gonna occupy as your primary residence and you gotta occupy it within a reasonable time. That's just one of the many things that the VA kind of glosses over, as well with all the other underwriting niceties, let's just call them. But perhaps one of the neatest things the VA does is the assumability factor of your VA loans. You bought a home a couple years ago and you have a 2.5% loan rate. Your VA loan is assumable to another buyer to take over that payment at the 2.5%. It's a little bit more complicated than I'm making it sound. A buyer can come in and take over that payment. But for example, it makes a big difference whether or not the incoming buyer who is assuming the loan is a veteran or has their VA benefits, or if they don't. You can do it either way. If the seller of the property wants to use his benefits again, he's got to get it freed up. Let's say he's buying a big house and he wants to go no money down, and the formula that I just showed you would require him to bring a down payment. He doesn't have it. He needs to free up his VA entitlement. Well, if he sells the current home and has somebody assume the mortgage, then, and if don't have their VA benefits, he's going to lose that portion of his entitlement with the same way that I calculated it before. But if they are a veteran or have VA benefits, they will use their own entitlement and resolve and relinquish and free up the entitlement of the seller. A lot of people don't realize that. They think they can just come in and say, oh, you have a VA loan, I can buy it for $600,000. I'll just assume your VA loan. That way I get 2.5% financing $600,000. You can only assume the amount of the loan that the seller has, and you got to make up the delta in cash. That kind of ends it for today. There's a lot of great reasons and why the VA is the best home loan on the planet. I really hope this was helpful. If you have any questions, comments, and I will see you on the next video. Take care. Have a great day.